Your bank has a secret. If you go to the bank and ask for a mortgage, they will ask you,
I need to see your income, your pay stubs, and your tax return.
right? But what if I told you there's a powerful loan that makes all of that irrelevant? That is a loan that successful entrepreneur use to scale their portfolio and make boatloads of money without ever showing their pay stubs. Stick around because I'm going to show you everything and why banks truly, sincerely hate this loan. If you find this helpful, please subscribe to our channel to put the word out. That helps a long way with the algorithm. Frustration with traditional loans. First, have you ever applied for a bank mortgage? Like, oh my God, they ask you for everything under the sun. Like, even the color of your underwear. Now, I don't have to tell them I put a thong underwear. This is my business, not theirs, but they will want to know it. Anyways, I do not really wear a tongue underwear, by the way. This is just a metaphor to explain the example, okay? See, banks rely on your ability to pay back, meaning your W 2, your pay stubs, and your tax returns. And this is where the problem is. This is where bank thinking is totally flawed. The solution, the secret weapon. You see, successful entrepreneurs almost never use the bank. They use this secret weapon. It is called a DSCR. It means debt service coverage ratio. Don't worry about the jargon. It sounds complicated, but all it means is, does the property pay for itself? That's it. So what that means is that the bank's favorite tool, which is your personal income, becomes obsolete. Why? Because this loan is not about qualifying you, it's about qualifying your property. Can your property pay for its own bill? So you see, that flips the entire script. Who uses DSCR loans? Who is it for? First, for entrepreneurs who want to scale their real estate portfolio. So let's say you like buying rental properties. So this is a mortgage that will be long term, cheap, so that your rental could cover the cost of the mortgage. Or as an example, if you had a bridge loan for a fix and flip, so instead of selling the property after you repaired it, you can decide to hold it long term. So this is perfect for refinancing your property, what they call a refi. Second, small business owners who want to buy a real estate for their business operation. So let's say you want to buy a warehouse as an example. In this case, you only have to prove that your business makes enough money to cover the mortgage, not your income, your business's income. Third, REITs, what they call real estate investment trust. And the big investment firm, they use that to grow their portfolio. And it's very aligned with their making money because each property needs to make enough money to cover for itself. That's how they make money and they grow their portfolios. The takeaway, the DSCR loan is a long-term tool that is cheap, up to 30 years, right? So it comes with all the bells and whistles that a bank offers you without ever having to show your pay stubs. How does DSCR work? Well, remember, the goal is to show that your property can pay for itself. So the calculation is just basically taking the income and dividing it by the expenses. That's it. As simple as that. Now, about the expenses part, it's called PTR. Okay, don't worry about the jargon again. This is just people in finance that are upping up the term so that they can be paid more. Okay, so it's called PTR. So PTR is the regular expenses that any house has. So P stands for principal. This is the part of payments that pays down your loan. I is for interest, the cost of the loan, how much interest you're paying on the loan. And then you have the taxes, right? The property taxes. And then, of course, you have the insurance. And then, since you rent out the place, you have landlord insurance, basically. And then, if you have an association, what they call HOA fees, so you have the association dues. And that's it. So, those are the expenses that get divided by the income. Now, once you divide the income by the expenses, you get the DSCR number. If that number, let's say, is 1, that means that you break even. Your income equals your expenses, right? Now, if your DSCR is, let's say, 1.2, that means that you make a 20% profit on that property, which is good. And actually, most lenders will require a minimum of 1.2 DSCR. And on another example, if your DSCR is less than 1, let's say 0.75, that means that you're losing 25% on that property. Not good. So it is a number that tells a lot. Just that simple ratio says everything about your property, right? So because of that number that means so much, the bank asks you for W-2, etc., pay stubs, whereas for the DSCR, they will ask you instead for lease agreements. And if the property is not rented yet, therefore, they'll order an appraisal that will give you the market analysis on what the rent amount should be on that property. And that's how you get approved for a DSCR. Again, it is based on the asset, not on you. So no drama there. Finally, very important, a DSCR loan closes in around 21 business days. So within a month. Whereas the bank, you can go for 60 days easily. So time is of the essence. Speed makes money. Let's take a real example. Now, we have our client Samantha. She bought a house for $400,000. Now, the down payment for the DSCR is 25%, so that's $100,000. So therefore, we lend her, the loan amount was $300,000. So we had Samantha do an appraisal to know what is the market rate for her renting a property, and it was $3,200. And then her monthly expenses, her PTIA, was $2,500. So when you divide those two, income by expenses, the DSCR is 128, meaning she's making 28% profit on the property, which is very good. And remember, the minimum in general that lenders want to see is 1.2, meaning 20%. So she's in the green. But as far as doing the economics of a property in rental, that is it. 1.28, simple calculation, guys. Why your bank secretly hates this loan? Well, first, the one thing that the bank cares about is, you guessed it, your personal income. So suddenly, with the DSCR, that goes out the window. Secondly, the DSCR is built for scale, meaning that when you do mortgages with the bank on your investment properties, the more properties you get, the more nervous they become. So they cap you at a certain number of properties, usually around 10 properties. Whereas for the DSCR, the more property that you get, it shows a bigger experience. And this is encouraged. It's built for that. That means that the more they will want to lend you and the cheaper your rates will be. It's two different worlds. One of them encourages you to get more properties, which is the DSCR, whereas the other one get nervous for every new property that you get. This is a huge difference. Third, it's built for speed because a DSCR loan closes within 21 to 30 days, whereas with the bank, it can take up to 60 days. What that does, that kills your deal. You have no chance of competing with cash buyers. So the DSCR is made specifically for that. So you have a chance to really secure great deals. This is huge in real estate. The trade-offs for DSCR. Well, remember, a DSCR is a tool for speed and to make money and to scale. There are trade-offs. First, the down payment is a bit higher. It's around 25%. We want to see that you have some serious skin in the game as well. Second, the interest is typically a bit higher than the bank, around 1 to 3%. Think about it this way. It's a premium for you not having to ever show your tax return or your income statement or nothing. This is a premium you pay for that. Finally, you should expect some prepayment penalties, meaning that if you decide to sell or refinance your property within a certain amount of time, usually it's 3 years, we will charge you some fees. This is a way for our investors to protect the return on their investment because they invested in you, right? Again, scaling growth and making money is the trade-off that you pay for a higher cost. The takeaway, guys, there's one simple takeaway. Banks rely on your income, whereas the DSCR relies on your property's income. Super simple, but extremely powerful. And that's it. If you like this video, you will love this one.